and welcome everybody. So I have to say I'm truly honored to be a speaker at Women of Wisdom and a WOW event. I'm usually relegated to the back of the office during these things with the other guys. So thanks for having me today. And Rhonda already mentioned that I have a brand new baby girl at home, and the overall message of WOW really hits home for me in a brand new way. When I think about how important it is that the women in my life are confident and knowledgeable in finance and have a safe place to ask questions and learn, that's really important to me. I'm also really excited that we have 5 different generations represented on this call. So we have some Gen Z, Millennials, Gen X, Baby Boomers. We even have some silent generation all represented today in the audience, which is really exciting. And because we have such a wide range of generations, obviously not everything we say will apply directly to you, but I encourage you to still listen because specific parts you may pick up to a helpful tip for someone else, or maybe it'll spark a question on behalf of that person as well. I also promise that we're going to touch on content for every generation and stage of life and keep this relevant for everyone involved. So with that said, let's get to it. So first I want to cover the format and some housekeeping items for everybody. So Megan and I are going to do everything we can to make this fun and not put you to sleep. So we're going to be alternating between trivia questions where you can win Amazon gift cards. And then we're going to also go over an educational section and then back to trivia, back to education, so on and so forth throughout the presentation. And we're also going to have a Q&A session at the end, but feel free to type your questions into the chat box along the way so you don't forget them, and Josh can collect them. So you can make sure your chat goes to Josh. So when it comes to the trivia, the rules are going to be the first person to correctly type the answer into your chat box to Josh will win the gift card. Again, your answers are going to be anonymous because they're going just to Josh, so feel free to take a guess and don't feel bad about any wrong answers. And we're going to be in contact with the winners to make sure they get their prizes after the event. So with that being said, let's go into the first trivia question here.
Really quick before we get started, this is Josh, and just as kind of a housekeeping note there, when you go to enter your answer in the chat box, at the very bottom of the chat box, there's a section where it says send to. So just make sure when you click in there that it says send to organizer only, and that it's not selected to send to everyone. So I think that's important. It should be automatically there. And then also, if you've just dialed in and you're not directly linked into the actual webinar, we're still getting some background. If you could just mute your line, because we're still hearing some folks, and it looks like we can't get that muted. So just a few notes there. Chris, go ahead and get started.
Okay, sounds good. All right, so with this first question, here we go. So question number 1, which 2 women have appeared on the $1 coin? And again, first person to type it in, so we can start to see. Oh, so we're getting close. You gotta have both answers. People have already said 1. Oh.
We got 1, you need both.
Okay, we have a winner.
Okay, all right, we have a winner.
That was fast. Wow, that was a lot of answers. A lot of people got 1 right away, and then so here's the answer. And so Susan B. Anthony and Sacagawea. So there's the first trivia. Susan B. Anthony was known by a lot of people there.
There will be no points docked for a misspelling of Sacagawea, by the way.
All right. Okay. So that's the first trivia question there. And then obviously, so we're going to switch back now to switching gears to the education side. So what we wanted to start with was the what and why. So we want to talk about what financial planning actually is, because it's got a lot of different definitions depending on where you're coming from, and then also why it's important in the first place. So let's jump in here into the what and why. So I'm going to start with a funny cartoon there. So I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. So I don't want anyone to actually have that experience or to feel an ounce of that. So I know it's a corny cartoon there, but I don't want anyone to feel that. And also everyone should feel prepared and confident that they're making the right decisions, whether you're just starting out or already enjoying retirement and planning your legacy and everything in between. So what we're going to start with is the book definition versus the real life feeling you get when you have a good plan in place. And you're going to notice a theme here throughout the entire event, and it's really important because in financial planning, there are typically 2 aspects that run through most questions. There's the math and then the emotion. And almost everyone, I think, instinctively views financial planning as just a bunch of math. I think even my wife thought of that about my job before she got to see me work at home a lot with the virus. But it's not just a bunch of math, but in reality, there's an enormous amount of psychology. And the psychology sometimes even supersedes the math of planning. And we're going to get into more of that later on. But so first, I want to just actually jump in here. So the book definition of financial planning is essentially, just, everyone can read it. It's a comprehensive evaluation, kind of where you are financially, where you want to go, and then how to accomplish that strategically. And then what I like to focus on, though, is really the real life impact of it. So, and the impact is really powerful. So again, my wife Kristen's listening right now, and I like to use this analogy, and it relates to her. So she truly loves when the house is clean and organized. Like, she's happier. There's a sense of peace. It literally radiates from her after a fresh cleaning or organization session. And everyone deserves to feel that peace of mind or that feeling in your finances too. But having your financial house in order and feeling confident what you're doing and you're doing all the right things. And to be honest with you, helping people have that feeling is a big reason why we do this as well for a living. So there's the definition and why it's important. And then, so let's get into the technical elements really quick too. So this is kind of the ingredients of a financial plan. So I'm not going to spend a ton of time going over this. You can see on the screen, there's basically 6 major categories of financial planning. And all of them interact in different ways to form a mosaic of an actual plan. And so, and every question in financial planning involves at least one of these. Sometimes it's 2, sometimes it's 3. Other times, maybe you need all 6 of these in harmony to actually go after a big goal. And to give you some insight into how I think as a financial planner is when someone asks me a financial question, I start rolling through these categories in my head and all the various nuances and how they interact together to actually answer a question. So I'm just going to give a 1 sentence real quick here so everyone's on the same page with these. So cash flow and debt management, basically the gist of that is where should every dollar go to be maximized. Investment planning is kind of the science and art of building a portfolio and managing other asset classes. Tax planning is often thought of as paying Uncle Sam as little as possible. That's usually the goal for tax planning. Retirement savings and income is what account should I save into or draw from if I'm already retired. And then insurance planning and risk management is as little insurance as possible while still being properly covered. And then estate and legacy is obviously planning for next generations and also for charitable causes too. So those are the 6 ingredients, and we're going to go into those a little bit deeper as we go through this. All right, so, and then the last part of this educational section of the presentation is financial freedom or financial independence. What is all this really for, right? This is the major goal of financial planning. So Jackie Mason there, I have enough money to last me the rest of my life unless I buy something, right? So financial freedom is not that. And so again, there's the emotion and the math, right? So the emotion is, or you no longer have to work, right? You get to stop trading in your most valuable resource, which is your time, and you have enough money to where it's generating even more money to actually live off of it. So that's kind of what it feels like. The math of that is essentially passive income plus investment proceeds has to be equal to or greater than your expense needs, right? So when I say passive income, to be very general for a second, think dividends from stocks, rental income from real estate, bond interest, Social Security, pensions, etc. It's basically income that you don't have to spend a lot of time to receive it. And then investment proceeds is when you liquidate an asset and actually have cash to be able to spend it. And as long as those 2 things meet your expense needs every month, then you're financially free. You're financially independent. All right, so that's the what and why. And we're going to switch over to another trivia question. So everyone get ready. I'm going to pass it off to Megan as well to take the next section and the next trivia question.
Okay, perfect. So our next question is question number 2. How much does a $1 bill weigh? You can go ahead and type in your answers.
Oh, no, I'm not seeing it yet.
One out. Oh, we got one.
Okay, got the answer. Nice job. Okay. Got the answer.
Can we display the answer?
Yeah, there's the answer. So 1 gram or 0.035 ounces or 0.002 pounds, depending on what. We got different measurements, people guessing in different ways there. So there you go.
Congratulations to our winner. Okay, so now we're going to go ahead and jump in and talk about the different financial stages of life. And as Chris talked about in the beginning, there are 5 different generations represented here in this meeting. So that means just about every person should be able to relate to at least one of these stages in some way, which is really unique and really cool. So we're going to go ahead and jump in to the development stage. And the key characteristics here is life is good. You don't really have a care in the world. You're not working or never had a job, and you're 100% dependent on your parents. So just like that cartoon shows, you do things as a kid because they're fun, you enjoy them, and there's no pressure on you to earn money because you just think it comes from that plastic card in mom and dad's wallet. I remember when I was growing up, my parents would, teach me about the value of money and how hard work pays off at a very young age. And I would go to my parents and tell them that there was something new I wanted to buy, whether it was a new toy or stuffed animal or whatever it was. And there were times, especially with the pricier toys, they would give me chores to do around the house, and I would earn money for each chore I did, so that I could work towards buying whatever that new thing was that I wanted. And once I eventually saved up enough and went to the store and bought that item, I was so proud of how hard I worked to get what I wanted, and it really allowed me to identify if that was something I wanted that badly to work for. Initially, I still didn't understand these values my parents were teaching me. Even after those exercises, I still thought money came from my parents' wallets, and it was easier to get than I realize now. But as I got older, I did start to really appreciate those exercises and what they taught me. So going into the core principles here, what Apriem is equipped to help your families do is identify your beliefs and values that drive spending behavior, and understanding how money decisions are made and identifying needs versus wants plays a huge role in a child's spending habits and their spending habits in the future. So now moving on to stage 1, which is you have your first job. You're probably really excited to get to work and experience earning your own money. And another personal story here, when my sister got her first job, she was so excited, and she figured out how much she was going to make every hour. So she multiplied that up and figured out, what a 2 weeks worth of work would pay her. And when she got her first paycheck, she was hit with a dose of reality when the amount on her check was so much less than she anticipated because of taxes. She went on and on and on about how unfair it was that the government was taking all her money because they didn't work for the money that she received. So that's what gets us into the core principles of this stage, is how financial habits and awareness teach us what happens in adult life. So what we learn in the developmental stage is really reinforced, and then we build on that to more complex topics. So this is where we really answer the question, why is it important to think about taxes, like in my sister's case? What is a budget and why is it important? And as well as starting to really identify those short and long-term goals, whether that's something as simple as, saving for, I don't know, an iPad, or bigger is eventually saving for your first car one day. This is really the stage where you can develop that and develop that well. And so now on into the next stage, which a couple of us in this room are currently in right now. So it's been fun to talk about that amongst each other and to see how everyone's experiencing it in their own way. But it's when you're starting your career and or you're getting married. We've dubbed this as the financial multitasking years. There's a lot going on, and you're trying to figure out what you want to save for and how you're going to do it. So as I alluded to, I'm kind of in the beginning of this stage. I just got married, and we're trying to figure out what we want to save for and what's most important to us. And Josh is also experiencing it too, and he has a story he can share about that.
Well, I would just say, and thank you, Megan, for the opportunity to hop on. As we enter the stage, and when we look at the number of callers that we have on the webinar right now, we have folks from all assets of these different stages of life. And so, as I entered into the beginning of the stage, I actually started my career in insurance. And when I was in insurance, I I think I was in the business for about 2 or 3 years, and I hadn't gotten any life insurance for myself at the time. And one day I'm driving this hand-me-down convertible top BMW Z3 that I got. It was all beat up, and this big truck almost ran me off the road at one point. And I remember, driving home, my hands are shaking because of the adrenaline, rush of that experience, having just happened, and thinking to myself, I have, my wife and my 2 small children at home, and I'm the sole breadwinner at the time, and I knew better, and yet if something had happened to me at that point, life would have been, very difficult for them. So literally the next day, I went and I got myself fully insured to make sure that if something were to happen to me prior to us, being at a point where we had accumulated all of our wealth, that they were taken care of, and that I could feel confident knowing that, if, there's something that happened along the way, I at least had done the right thing to take care of my family, along the way. And it wasn't hard. It was very quick and easy and a painless process. And yet, I'm very, very happy that I've taken care of that. So that's my short little story there of kind of entering in the stage and the idea of risk management playing a very crucial role as we begin to build out our own financial empire. All right, I'll pass it back to you.
Thank you, Josh. Yeah, so as we can see from that story, there's a lot of value in starting to plan as early as possible and just being prepared for anything that life throws at you along the way. Another key important things in this stage is just, along with identifying your goals, is just identifying your risk tolerance, because that does play a big role in how you will accumulate your wealth, and it will affect how and when you reach the goals that you set for yourself. And now, heading into the next stage is stage 3. That's when you can see the light. You're in your peak career years. You can see retirement, but it's not quite there yet. You're making the most you ever have, and most likely spending the most you ever have at the same time. So for example, this may be when you're in the midst of paying for your kids' college and realizing how much more expensive college has gotten since you were in school, which is something Rhonda can actually attest to.
Yes, I can, Megan. Thank you. Yeah, college is expensive. It has the highest inflation rate year over year than anything else. That's why having a plan to pay for college is essential when you're starting a family. As many of you know, I have 3 sons, 3 boys. So you can imagine how much we've already spent on college. And as a side note, my youngest son graduated from high school actually today. We're very excited for him, and he'll be off to college this fall. So I'm almost to the promised land of being an empty nester and almost having college paid for. So saving for college early is key. My husband and I started saving in custodial accounts for better known as UTMA accounts, Uniform Transfer to Minor accounts, as well as 529 college savings plans for my boys early on. We started with a small amount each month for what we could afford in each one of their accounts, and as we became more established in our careers, we were able to increase the monthly amount over time. What really helped with our education as well for the boys were gifts from grandparents and family members for birthdays and special occasions. And as a practice, I would sock away all of those monetary gifts over the years into the boys' UTMA 529 account. So I can actually thank, and my boys can thank, all of their family for helping them get through school with no student debt. So the key to this is plan early when you're just establishing, when you get married and you're starting your family, is to save early, save regularly. It doesn't matter the amount. You can increase it over time, but every little bit helps. So thank you, Megan.
Thank you, Rhonda. And Rhonda's story is a great example of why the financial planning done in stage 2, the multitasking years, provides so many opportunities for success in stage 3, the one we're talking about right now. It's definitely a success story of how having a good plan in place can make you even more prepared for those education expenses. And even on top of being prepared for expenses like college that come in this stage of life, there's also great importance on planning for retirement and asset management as you're getting closer and closer to those retirement years. Which brings me right into the next stage, stage 4, living the dream. You've reached retirement, life is good again. You're winding down and getting to do the things you love. And even though Chris is still in the financial multitasking stage of his life, he's certainly getting some great ideas on how he'll be able to spend in his retirement. Isn't that right?
Oh yeah, no. So one of the most interesting things I think about my job from my own personal perspective is watching hundreds and hundreds of people go through retirement. So I think I'm going to be really good at it after watching people do it. And I'm also getting good at living vicariously through people's travel. So hearing all these amazing travel stories, I think I'm going to have it all mapped out pretty well here. So yeah, no, it's definitely very inspirational from my perspective as a financial planner.
Indeed. And being able to check in on your retirement plan and even updating it during this stage is definitely something that should be a habit as you navigate through these retirement years. And it's also a good time to think about the cost of taking your dream vacation, if that's what you want to do, or the amount of money you want to put into your health and fitness, as well as long-term care. And that just goes back to Josh's point from his story earlier, just about being prepared for whatever life throws at you. And then from the planning perspective, it's also of great importance in making sure the estate plan is up to date with a focus on income for yourself, as well as accumulation and growth to pass on to your next generation. And then the final stage, which we've called the legacy stage, we joke that you can't see the light anymore because you are the light. So this stage answers the question, what knowledge, wealth, and network of resources have you given to the next generation so that they too can achieve financial success and preserve the wealth that you have worked so hard to pass on? So basically, this is the culmination of all the time you've put into saving, planning, and executing your financial goals, just like Chris will be able to show us in the next section here.
Yeah, so stage 5 is such an interesting stage because one of my favorite parts of my job is also just taking time to talk about legacy with the next generation. And some people on this call, we've had those kinds of meetings with their families. And I can't tell you, if you haven't done it yet, how powerful a conversation is when there are multiple generations in the same room. It's just incredible to hear, both as the future successor trustees, but then also the one who's passing on the wealth, to have that open dialogue is really powerful conversation. So definitely highly encouraged to do that kind of a thing.
Great. Well, thank you, Chris. And before we move on to the next section, it's actually time for another trivia question. So I'll let that get put up on the screen. Question number 3. How many companies are in the Dow Jones Industrial Average Index?
Here we go. Oh, okay. We got to answer right away. Wow, that was fast. That was super fast. Within like 5 seconds. All right. So the answer is 30. And if you're curious, those are the 30 in the Dow. First one. There you go. All right. And then Josh is going to be reaching out to the winner there. Just light and fast. All right. Okay. So next stage here. So, and I love Megan's that last section she went over, just because for me, it's just, there's always intelligent things to do at every stage, and they continuously build on each other too. And it kind of is a perfect segue to the next one. So there's a little bit of a cryptic title here, 1,000 potential futures. And some of you might already know what that is. But for those of you who don't, we're going to jump in here. So first is, for those of you who do already have a financial plan and have been doing this, this is not, it's going to be repetitive for you, but for those of you who haven't, what I wanted to do is just take a couple of minutes and show you what financial planning actually looks like for our clients and in real life. And so bear with me here 1 second. I'm going to switch gears to a different software. And all right. Okay, so the next section I'm going to cover, and everyone's screen should be changed now. So this is actually a sample client. So I'm going to introduce you to Adam and Allison Affluent. I'm going to show you kind of some different interactive sensors that we work in here. So the first one I'm going to show you is just a basic, it's our decision sensor. We do a lot of planning here. This is going to look familiar to a lot of the clients on the call. And just to catch everyone up really quick on what they're looking at. So each bar is 1 calendar year. The y-axis is the liquid amount of assets that this sample client has. The x-axis goes out to whatever age we want, right? So this is essentially just a bar graph projection into the future. On the left-hand side, you have all these different variables that we've built for the sample. And what they do is they represent changes that someone could make on their financial plan. So what I'm going to do is just kind of do a little simulation here where, what if Adam and Allison spent a little bit less? So they're currently spending $110,000 a year in this plan. And I'm going to drop them down to 70 arbitrarily, just to kind of show you the effect. So you see value gained, or green on the graph. So value gained over time. And then I can also flip that the other way though. So what if they spent a lot more? What if they spent 140 grand after tax every year? Right? Okay, so that's a little bit too much for Adam and Allison, right? Because now they're, right, so there's gray and value lost over time. So that's a really simple example, but what the software allows us to do in this setting is to step outside of the timeline and actually take a look at the mathematical impact of a decision before it's made. And it's not just expenses, there's so many different things here. Maybe you're considering traveling more in retirement. Maybe you want to consider moving to a different state with a different tax rate. When to take Social Security, bear markets, buying and selling real estate, for example. All those have so many different impacts and aspects to a plan. And so that's one way to look at retirement, though. And what I want to do is introduce the concept of 1,000 potential futures. And that was a part of the title of this entire presentation. And so what I want to introduce is a little more advanced financial planning, which is what's called a Monte Carlo analysis. And again, some of you have seen this before. Even if you haven't seen this in your client, just know that we actually run these quite often behind the scenes. This is a great way for me to look at a plan statistically. So I'm going to spend a ton of time on this, but I'm going to take you all the way back to Stats 101 class, where you have a bell curve distribution. So instead of a bar graph with static assumptions, I'm doing basically you have 1,000 different outcomes here in a spread pattern. It's a bell curve turned on its side. So you have the median, right, standard deviations there. And anyway, so this is 1,000 different. And what's so important about this? It's not just static assumptions. It's the vicissitudes of life. It's all the variables changing, right? It's returns oscillating over time. It's inflation going up and down. It's people passing away at different times, right? There's no static assumptions here. Just lets life play out. And what it does is it presents itself as a percentage of success. So out of 1,000 potential futures in this specific sample plan, there's an 84% probability of success. So there's, in other words, 840 lifetimes out of 1,000. Adam and Allison affluent did not run out of liquid assets, right? And so just to kind of take it one more step further, and then we'll take a break from this part of the software, is, if I go into the plan here, I'm going to introduce you to one more center here. It's a goal planner. And what this does is it allows me as a financial planner and you as a client to see side-by-side goals stacked against each other. Right? So, and so I can hear some people talk. Everyone has this, and if we haven't shown you it, we're doing it behind the scenes. And this is I'm kind of giving you an inside look at how I think of things as a financial planner, not just set assumptions. We're actually running statistical analysis behind the scenes and running thousands and thousands of iterations to make sure that we're as statistically accurate as possible. So, all right, I'm going to take a break from all the math here. I'm going to go back to the presentation. And if you have specific questions about Monte Carlos and all this 1,000 potential future talk and the planning in general, again, you can ask this Q&A, but then also I encourage you to follow up with us one-on-one after the meeting here. All right, so we're going to go back to the presentation. That's a sample of what planning actually looks like. Okay. All right, so next trivia question. Number 4. Everyone ready? I'm ready. Josh, ready? Okay. What is the most counterfeited bill in the U.S.?
Bill Gates.
Oh, okay. Wait, wow, that was super fast.
Okay.
Yeah, we already got it.
Yep. It's in.
Congratulations to the winner.
Who's the first person?
Oh, that's a familiar last name.
Nope. Oh, there we go.
No, right there. Okay, Josh will be in contact with the winner there. And the answer is the $20 bill. Second most, if anyone's curious, is the $100 bill. Basically, the gist of it is that the $100 is a little too big and the $20 easier to hide. So that's the most counterfeited. Okay. All right, so and then this next section, what we're going to do is basically what I did was I kind of queued up tough questions. And these are very common questions that we get asked. And they're loaded questions on purpose. So the answer to these, as you can kind of tell as we've gone through this presentation, the correct first answer to most financial planning questions is, it depends. And everyone on this call is in the know. If someone with a Starbucks degree in finance or a Google degree in finance tells you, you have to do it this way, they're probably wrong, because the answer is, it completely depends on the stage of life you're in, depends on your taxes, depends on your cash flow, depends on where, when you want to retire, how much do you want to retire. All these different variables play into, and the answer is actually very customized to one person. There's not a one-size-fits-all answer. And true story, I was actually just talking with a potential client who was interviewing us and 5 other advisors. And this person asked the advisor, when should I take Social Security? And the other 4 advisors said a very specific age without asking any follow-up questions. Luckily, Josh and I answered, it depends. And he immediately said, wow, you passed my test. The answer to most questions should be, it depends, right? And so with that being said, I'm going to go into some of these and just kind of show you, I'm going to think out loud with you on the answers to these questions. So a very common one I get is, should I pay off my house or invest? And by the way, you could easily insert, should I pay off my car? Should I pay off my credit card? Should I name a debt? Name some kind of liability. And the answer is 1 part emotional and 1 part math. You could get someone who's a big believer in the Dave Ramsey method say that it doesn't matter, I don't care about the mathematical effect, I need that debt paid off, it's priceless to me. And by the way, I completely understand and can agree with that depending on what that person's plan's at. From a mathematical perspective, just to give everyone a couple of my 2 cents here, when you think of a debt, it obviously has an interest rate you're being charged. When you put an extra dollar down against that debt, just think of it essentially as reverse investing. And so if I'm being charged 20% on a credit card and I choose to pay extra dollars down on that debt, then I'm effectively getting a 20% rate of return. And that's a really high hurdle. It gets a little harder when you have something like, should I pay off my house? Because first of all, it has a lower hurdle. So maybe the mortgage rate's 3.5 or 4 or 4.5. And so you're comparing, what can my dollars do versus that 3.5 or 4.5% return from a pure math perspective. But then I'm sure people are already thinking, well, what about the tax deductions and things like that, right? I'm going to go back to one of the very first things I said to everybody, which is those 6 key categories rolling around in my head. You have to take it to multiple levels down to that person's tax situation. Are they getting a tax deduction? Are they not, right? And that plays into the math as well. It can slightly alter the math and the opportunity cost. So I wish I could give you a black and white answer, and it really is, it depends. And I can answer for you specifically, and there are people on this call where I have answered that question for them, but it takes deep planning to be able to accurately answer that question. And you can see the other 2 questions are also very loaded questions, right? So do I have enough? How much should I be saving? Well, it kind of depends, right? So to give some more stories, if I have a client that wants to travel the world and golf every major golf resort, and that retirement is a lot more expensive than the person who's very content just riding their bike and reading on the beach, which is basically free. And so those are 2 very different answers with how much of a nest egg those people need to have built, right? And how much I should saving is a subcategory of that for anyone who's on the stage development through stage 3 or 4-ish. How much you should be saving, again, it's the same answer though, just in reverse, is you want to work backwards from whatever that goal is. To give everyone a very general rule of thumb, for every $1 million that you save, you can typically take somewhere between 30 and 65K out. Now I'm being very general there, and it depends on the kinds of accounts, but just to kind of give everyone one little two cent tidbit there. Okay, so the next one, what's the best investment? Stocks, real estate. I get this one all the time. And again, the answer is it depends. There's so many pros and cons with every asset class. So anyone who definitively says, oh, real estate's better, stock's better, again, it really depends on that person's situation. What kind of an account is it held in? What is their goal? Do they have liquidity risk? Is there timing risk? Now, with that being said, again, I'll give you a helpful tidbit here. You can normalize rates of return across asset classes. And so I'm not going to go too deep into it. If anyone's really, really curious about this question, we can have a more one-on-one conversation. But you can basically normalize returns across real estate, stocks, and other asset classes using cap rates and rates of return and things like that. So that's the everyone's a little bit more in the know. The answer is it depends is the first answer, and then you can go deeper, and then eventually you can answer the question.
And so, Chris, what does it cost for people to get a financial plan?
So we'll show that at the end. But everyone on this call, we're willing to do it as a complimentary plan. So anyone who has not had a plan, then we'll do a complimentary. Anyone who has a plan, of course, most of you are already getting updates, but we can always update that as well. So, all right. So with that being said, we're going to open it up to. I'm sorry. Before we go to Q&A, we have 2 more trivia questions. My bad. Okay. So Megan, you want to do number 5?
Yes, number 5. Who is the wealthiest woman in the United States?
Oh, wow. Oh, no, nope, no one said it yet. Everyone has a very similar guess so far. Nope.
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 Wait. That's close enough. I think that's close enough.
Yeah. Different. Yeah. Yeah, we have an answer.
So, all right, we have an answer. I think it's a close enough answer.
Alice Walton, who inherited money from Walmart.
There you go.
Okay, are we ready for the final question?
No, wait 1 second. I do have to say that I think Shrek was a fantastic answer. Well, close, not correct.
Yeah. All right. So number 6, final trivia question.
Okay, it is, who's the youngest billionaire in the United States?
Nope. No one yet. Nope. Yep. Oh, someone has it.
Is that close enough?
Yeah.
Okay. All right.
I've had multiple answers. Yeah.
All right. We got it. We have a winner.
Yep. Kylie Jenner. Quick little side trivia. She replaced. So Mark Zuckerberg used to be the title holder at age 23, and Kylie replaced him at age 21. Pretty young for a billionaire.
Very young.
All right. Okay. So thank you for playing all the trivia. Thank you for everyone listening. And we're going to open it up to Q&A again. Please submit your questions to Josh. And we have a little bit of time here to answer some Q&A.
All right, and just as a side note, we do if you have questions for Chris regarding any of the financial planning or anything we went through, you can submit them in the chat box, and we'll go ahead and address any of the questions that you may have.
Okay, we're starting to get some chatter here. Just letting some questions come in.
So Chris, there's a question regarding if we can send out the Monte Carlo summary as a PDF.
Yes, we can run Monte Carlos and send out the summaries via PDF. Absolutely. Yep.
All right.
And yes, Monte Carlos can be. Oh, that's an interesting one. Okay.
This is a really good question that we just got. Could you explain what market volatility is?
Yeah. So, want me to take that one?
Yeah, you're welcome.
Yeah. So I would describe market volatility broadly as the quote-unquote yo-yo effect of the market. So I guess I'm going to answer that, and let me take one big step back for just a second. So I want to make sure everyone on the call is on the same page. Again, we have a vast amount of generations here. So what's actually making stocks go up and down or indexes go up and down? Think of the stock market as a literal auction going on throughout the day. So if something's worth $1,000 and the next bid that gets filled is $1,001, the new price is set at $1,001. Next bid $1,500, it jumps all the way to $1,500, so on and so forth. And so market volatility takes that same concept and keep extrapolating that to where people are bidding constantly higher and lower on prices of things, and that's the volatility. So what you experience, for example, anyone who had a portfolio and went through the downturns of the virus, market volatility was skewed towards the downside because there were many more sellers than buyers. So there was a consistent amount of bids coming in lower and lower and lower, which kept driving price lower and lower and lower. So I hope that answers your question. If you want more clarification, we can always do a one-on-one to answer that as well.
Okay, so we have another really, really great question coming in here. Chris, you mentioned briefly that for every $1 million, you could spend approximately between $35,000 to $60,000 annually. Does this mean that you would not run out of money before you die?
Excellent question. And the answer is that I was hesitant to even give that tidbit because there's a lot of nuance that goes into that. It's a very general thing that I said. The higher you skew towards 60 or higher per million, typically what that means is your principal will slowly but surely run down. So to answer that second part of your question, it means you will not run out of money cash before you die. Anything in that 35 to 60 has a chance to be indefinite. The closer you are to 35 or less, then it becomes where you're not even dipping into all the interest, let alone principal, and it will continue to go up and down, or up, over time. Hopefully that answered the question.
Do you have a favorite stage that you prefer to plan and advise people on?
Ooh.
Favorite life stage?
I think my favorites, I'm going to take the first, middle, and last, because those three. So the first one is, first of all, just very fun, talking to young kids about money. Mm-hmm. Where does it come from? What it is and the concepts of it. The middle stage is fun for me as a planner and enjoyable because it's incredibly complex. There's so many moving parts, and you're often using all 6 disciplines in financial planning. And then the last stage is so interesting because it's so powerful. Having those kinds of legacy conversations and airing things out in the open between multiple generations. So, yeah.
How about you mentioned briefly about the Uniform Transfer to Minor Act and UTMA accounts? Huh? How does somebody set one of those up? But I just have to add in here because I think this is great. I go to a lot of birthday parties for children in my family who already have a lot of toys.
Yeah. Yeah. No. I can tell a personal story. So my nephew has quite a few toys, and we decided to set up a UTMA, and we can contribute in the UTMA instead of giving a gift. And so to answer your question, how to set up a UTMA, it's very simple, and we actually have. So for anyone who's unfamiliar with how Apriem is set up, we have 4 distinct departments here, and I'm really proud of the fact that we have 4 departments that can help people out. So big shout out to our operations team, who's led by Sean Covarrubias, and Lindsay is there, and also Sunny. And those 3 ladies are amazing at what they do, and they can help you set up a UTMA very easily. So reach out to them, reach out to us, and we'll put you in contact with them is the short answer.
So Chris, could you explain what an estate plan is and why it's good for someone to have one?
Yes. So estate plan. Okay. So let me do a huge myth buster here for a second, because before I got into this as a career, I thought of it the same way. So when I hear the word trust, I immediately think of trust fund baby. I think of super wealthy person that, a silver spoon, right? But a trust and estate plan is so much more than that. So when I hear the words estate plan, I think of essentially, in summary, what's going to happen to my assets when I pass, and I'm going to control the outcome of that. So whether you have a house and some cash in your name, whether you have millions, whether you have 100,000, there's good reasons to have estate planning at all levels. So I am not particularly wealthy yet, and yet I have an estate plan more for my 2 young kids. So I have a 2-year-old and a 3-month-old, and I have an estate plan in place in case me and my wife both pass away, mostly for guardianship provisions. So there's not just financial aspects of estate planning. Yes, of course, that touches on finance, but there's so many. That's a huge question. So hopefully,
I think you did a great job of answering it. I think that the real answer comes down to it depends when it comes to why you should have it.
Yeah, there you go.
To help you get through.
Yeah.
Through whether or not it makes sense for you. Here's a really good question too, and I think it can probably be summarized fairly quickly. But what's the biggest mistake that most people make when it comes to financial planning?
Ooh, that's a really good question. I'm gonna. Oh, go ahead.
I would like to jump in.
Yeah,
before saying anything else, I think the number one biggest mistake is not having a financial plan.
There you go. That's a good answer for us to start very broad.
You can get into all kinds of things about financial planning itself, but the biggest mistake would be not having a plan to begin with, because that's your guide. How are you going to get to your goals if you don't create a plan to get there? Chris, if you had anything extra you want to add, or?
I would say, so besides that, it's a great catch-all answer. And then to add maybe a little bit of specific things that are rolling through my head right now is number one, thinking it's too late, or starting too late, right? So either thinking it's too late, they kind of go hand in hand in some ways. I heard multiple people, or even talking to neighbors, where, I'll talk to a financial planner 6 months before I retire, right? And from a financial planning perspective, even just at least talking and getting a preliminary plan is so helpful because there's so much more efficiency and wealth that can be built starting earlier. And then the other thing I'd say is people making the mistake of stopping their compounding early. So for all the younger people on the call, it's very discouraging when you first start investing and you see only a few dollars in interest. But you have to think in terms of percentages. So 10% on $100 is only $10. That doesn't feel like a whole lot. That's like a Chipotle bowl, right? But 10% on 10 million is $1 million. And so as it scales, it's very powerful. That compound effect is, our brains aren't wired to think in a compounding way. And so that's the other mistake, is people underestimate doing small amounts of money, or they give up too early.
Okay, this is a very specialized question.
Sure.
So if this would be more of a follow-up offline, we can. But specialized question, if your son gets a partial athletic scholarship, does he need to file a tax return?
So, okay, that's a really interesting question. I'm going to speak generally for a second, and please, I encourage this person to follow up with us specifically. So if you have scholarship money left over after covering qualified education expenses, technically, you're supposed to include the remainder amount as a part of your gross taxable income. So depending on how things are set, so the answer is, I need more information to be able to answer that. So please follow up with me specifically, and I'll answer that.
How about how many months worth of savings should I have before I begin to invest?
Ooh, that's a good question. So if you were to ask, so this is, I'll share some more personal stories. So my wife thinks of me saving into our investment accounts as embezzling money. And so the answer may not always be the same, right? So there's some nuances there. I would say, as a general rule of thumb, if you have anywhere from, if you're in accumulation stage, 3 to 6 months. If you're in retirement, the amount of cash you need on hand can actually be less because you have access to your portfolio. So maybe counterintuitively, you might not actually need as much cash heading into retirement because you have some safety in the fact that you can get into your portfolio.
Okay, I think that is if there's any last questions, now is your opportunity to submit it. Okay.
All right. Time to go to Rhonda.
All right. Well, thank you, Chris, Megan, Josh. I'm so very proud of this team. You did a great job. This was our first virtual event. We had over 50 participants, which I'm just thrilled with. I know there was, throughout the call, I will say we had a little bit of technical difficulty with lines not being muted, as well as some background noise. So our apologies for that. We will get these kinks worked out as we go forward. We hope you enjoyed it today and got some good information out of it. Financial planning is very broad, very detailed. I would encourage clients to call us, and if you haven't gone through the financial planning project, that it's highly recommended. We address everything. It is a comprehensive plan. For those of you who aren't clients and maybe a friend or a family member on the call, Chris and Megan would love to do a complimentary plan for you to get you started. So please reach out to them in the coming days and weeks. Again, I hope you all got some good information out of it, even if it's one thing. I would love your feedback. You can send me an email directly to rhonda@apriem.com or give the office a call at 949-253-8888. We have Chris and Megan's information up on the screen, and it'll stay up on the screen for a little bit, so you can take that down if you don't already have it. But feel free to call and schedule a call or a meeting with them. We're getting really good at the go-to meetings as far as our client reviews and updates. So If you haven't scheduled a review lately with your wealth manager, please feel free to give us a call and we'll get that scheduled. I think you guys are all pros. I mean, we really didn't have too many glitches. You all did a great job getting logged in. So also be on the lookout for the next invitation to our next WOW or Apriem event in the coming months. Stay well, and we'll see you all very soon.
Thanks, everyone.
Thank you.
Thank you.